February 2nd, 2018, Dow Jones drops 666 points. A little bit scary. Is it a coincidence or is it a definite bear sign? I wanted to bring your attention today and share a very good source. If you're looking to find more information about stock market crash in 2018, visit marketcrash.money. And in particular, if you click on Market Crash 2018, you'll find some great information on why stock market crash in 2018 is a definite possibility. Now, we have been talking about this for a couple of months, and the crazy thing is nobody wants to hear it when the market just kept going higher and higher. Now, the same signs that we noticed a couple of months ago are the same signs that are driving the markets lower today. But all of a sudden, now people do want to know if there is indeed a potential for a market crash this year. So this site right here will answer all of those questions. I will briefly go over the 9 bear signs that are absolutely impossible to ignore. And more importantly, click this link when you go to the website on how to profit and find out how you can preserve your capital, preserve your positions, and possibly take advantage of what may be the biggest opportunity in the stock market since 1929. So what are the possible 9 bear signs that you absolutely cannot afford to ignore? Well, sign number 1, highest level of margin debt in the United States history since 1929. As you remember, in the roaring 1920s, everything was wonderful, everything was beautiful, the economy was great. People were borrowing money like crazy and betting it on the stock market. And that is exactly what we're seeing in the stock markets now, that people are borrowing money on margin like never before and betting that the market is just going to keep going higher. Well, we know how that situation unwinded in 1929. And it's impossible to ignore the similarities that are currently taking place in the current market. A few good graphs and videos have been gathered here that you guys can check out. How will the rise in interest rates affect margin borrowing and what is about to happen? Reason number 2, goodbye stock buybacks. As you have known, because the interest rates were so low for so long, a lot of companies have been simply supporting the stocks of their own companies at high levels and have been using the stock buybacks to create artificial demand to actually drive the stock prices higher. Well, as the interest rates rise, it's apparent that less and less companies are going to be able to take advantage of that. As a matter of fact, if you might or might have not known, it was actually illegal for companies to buy their own stocks until 1982. And apparently since 1982 it was perfectly fine, but the main reason it was prohibited before is because stock buybacks were considered to be price manipulation. So prices have been manipulated for many years in the stock market by companies buying their own. And the prime example is Chipotle, that drove their own prices from $600 to $800 a share. And you know where the price of Chipotle is today. It's around $300. Reason number 3, huge internet monopolies like Amazon, Google, and Facebook, are literally creating the closure of many small companies around the country. And they keep saying that the economy is great. And they can keep saying that. However, you cannot not notice or not acknowledge that we had some major closes of businesses that have been around for a long, long time that's been piling for bankruptcies in 2017, and unfortunately that trend is continuing in 2018. As a matter of fact, there are articles out there that provide information on how the total number of closures that's been disclosed to the public has been suppressed, and the true numbers exceed the real store closures, not by a few hundred, but literally by thousands of companies that were not disclosed publicly that were actually closed. Now, careless lending practices seem to be back in style. We're witnessing the highest level of student debt in the history of the United States. It's even hard to say $1.5 trillion in student loan debt. Now, as we know, the way the student loans are structured, it's almost impossible to pay them back. It takes many, many years. And unfortunately, even though the price of education has quadrupled in the last decade, the quality of education has not improved. So we're in a situation to where many students graduate, they go in the marketplace, and a lot of them actually struggle to find a job, not just a job, but the job based on their curriculum of study that their degree was devoted to. So people are struggling to find a high-paying job right after college, and therefore it diminishes their ability to pay those student loan debts. But what we're seeing, there are companies out there that coming out and say, hey, don't worry about your student loan debt. Hey, we know you're a fresh graduate. We'll help you get into a house. Don't rent, we'll help you sell a house. And they neglect the fact that, these loans would have never happened because the credit lines of these people are completely maxed out. So all of a sudden, the debt to income ratio is not a consideration. And that's really was the number one default reason for the loans in 2008 in the housing market. So it seems to me that the history is repeating itself, not with the housing market this time, but this time the bubble is more likely to burst in the student loans. And on top of everything, the situation is way worse than what it appears to be, because in the housing market, they were calculating the delays when somebody doesn't make a payment for 90 days. The loan was considered to be delinquent. Well, in student loans, they don't consider a loan to be delinquent for 270 days. So who knows how many people are actually behind, not just 90 days, but 120 days, 210 days. I mean, we're getting close to a year worth of time until they actually consider the loan to be delinquent. So the numbers are just horrific. The situation with the car demand, obviously it's been good in the last few years, but as the interest rates rise, the math is simple, and the math never lies. If somebody wants to go in and trade their car, guess what's going to happen? It's elementary. Their car payment is going to go higher because of the higher interest rate. Because the current demand for cars is at its peak. People are not getting as much money for their trade-ins. And so a lot of the customers made those loans with zero down payments. So their car value in the relation to the loan value is what is called in the industry as being upside down or buried. And so customers are having negative equity. Those are three typical terms that are used to describe a situation where a customer owes more on a vehicle than what its current present value is. And the main reason because of the 0% interest rates, of the zero down payments. The customers were not bringing any down payments to the table. They were also financing their textile and license in the loan of the vehicle. So literally what they were doing, they were borrowing not just the value of the vehicle, not just the MSRP, but they were borrowing in some instances 110, 120%, up to 130% of the MSRP. So now they bring this vehicle in, they're not getting enough for the trade-in value. The interest rates are going up. Okay, this is a formula for a car market disaster that is about to happen. Or in other words, we call it a Carmageddon. the highest level of credit card debt in the history. And as you know, a lot of people recently maxed out their credit cards to buy Bitcoin. Well, those people bought Bitcoin on 15 to 20,000 level. They've maxed out their credit cards. And where's Bitcoin right now? Well, it's at 8,000. So they maxed out their credit cards in hopes that they will make money, which essentially was going to help them pay off the credit card, which essentially was going to help them pay off the student loan debt. But what we're seeing is that it's definitely not happening. And so now more and more people are stuck with the credit card debt, student loan debt, and a lot of them, they have adjustable interest rates, which means when the rates in the United States go up, so as the credit card interest rate will automatically go up. And unfortunately, there's many loans that are structured that way. So the monthly payments on all those borrowings, they're going to go higher. Lowering corporate tax rate is a good temporary solution. However, the long-term solution is increasing productivity and output of the entire country. By lowering the corporate tax rate, a lot of companies simply took that money and they have given the money to employees in the form of bonuses that were not tied to production. They increased the hourly rate in instances from $8 to $12. In some cases, companies have increased the minimum wage from $10 to $15. Now, by doing that, what they really have done is increased the cost of doing business, the cost of staying in business, which is okay if the company is able to pay that out on sustainable in sustainable manner for years to come. But if the company's sales are affected, okay, as we are going to see in the car business arena, for example, then those same companies are not going to be able to maintain the same payouts to the employees if the sales are going to go down, which they will. And when the sales are going to go down, they're not going to be able to keep the same employees that they currently just given a pay raise. The problem with that is it's an artificial pay raise. In other words, it is not tied to an increase in production. It's like winning a lottery. What happens to most people that win the lottery? Well, they go broke within a year or two. They spend all the money and they're in the same spot where they started. So this is exactly what this corporate tax rate creates. As you heard, probably a lot of CEOs are getting pay raises, are getting bonuses. And again, they have not done absolutely nothing different to earn that extra money. In other words, there is no increase in output or production. This is just more money for the same output of production, which does not help the economy. So yes, right now everybody's going to get that bonus money. They're going to go spend it. But long-term wise, it does not help the economy. But on the opposite, those people that just got a pay raise that they really did not earn through increase in their skills or output, they're going to go get an extra house, an extra credit card, a bigger car payment. And when they're going to be laid off in a year or two, who's going to make those payments? Well, they're not going to be able to, because they're going to go into the marketplace and they're not going to be able to get that $15 an hour. And a lot of them are not going to agree to work at $10 an hour because they just establish a completely new lifestyle around $15 an hour. And they're going to end up back in the unemployment line. So that's not a long-term solution. And that will impact negatively the economy of the United States in the next 2 years. But we can possibly see some of the outcomes already tied to that by the end of 2018. So here's an example. They tried to increase the minimum wage in Canada, and this is what it led to. It led to major layoffs. 6,700 jobs were lost. So we don't learn on other people's mistakes. Eventually we will learn on our own mistakes. So free tax money is not a solution, will have negative impacts. All right. Now, bear sign number 7. Bitcoin crash may trigger the market crash in 2018. I briefly just described that. A lot of people are going out, and they're not just maxing out their credit cards. They're going out and taking equity loans on their houses. And so, naturally, as the price drops, and it did drop, and if it continues to drop, then people are going to sell the Bitcoin. They're going to lose out on all that money that they're still going to need to pay back. Bond market collapse may trigger market crash in 2018. It's very interesting how Morgan Stanley sells all their bond holdings that were marked at a certain risk rate and warns of a recession risk in 2017. However, nobody pays any attention. And according to one of the top hedge fund managers, David Tapper, on January 4th, actually 2017, he came out and said, look, the market can't go down until the bond market gets hit. It's amazing where interest rates are, which in 2017, of course, they were still low. Now everybody seems to realize all of a sudden that the interest rates are going to rise. And if they are going to rise, then the bond market definitely will get hit. And David Tapper has not been wrong for a decade. So if he's right about this, and interest rates are fixing to climb, and everybody's getting worried about it because they know the bond market is going to crash. And according to him, it's the bond market crash that will take all the other markets down. US dollar collapse may trigger market crash in 2018. The de-dollarization trend is in full mode. Many countries outside of the United States are starting to use what's known as a petrodollar less and less. 40 years ago, the United States made a deal with the rest of the world. We're going to use United States dollars in world exchange for important things like crude oil and natural gas. And so for many years, that's been the case. However, now in Asia and parts of Europe like Russia, they're not using United States dollars anymore. They're using Chinese yuan and Russian rubles, and that naturally is decreasing the demand for US dollars. They have found out a way that they don't need the United States dollar. And as the United States dollar demand decreases, so will the value. It turns out nobody knows if the United States actually has the gold reserves that it claims that it does. And there's a lot of support data that the United States probably doesn't have any gold, because recently when Germany demanded its gold that the United States was holding for it a few years ago, the United States wouldn't even allow Germany to come in and investigate their own gold reserves. And that was just very peculiar and very odd. And eventually the United States did let them investigate just one room of their gold reserves. And when it tried to, instead of paying Germany back all of its gold, which they were supposed to do upon its demand, there was a delay in payment, and they couldn't pay it all at once. They told Germany that they have to pay them back on a payment structure through 2023. And the first payment they were able to make was actually not even a full payment, which was supposed to represent, I believe, roughly about 10%. So no gold reserves. Potential wars around the corner. Less and less countries are using dollars. They're finding their own ways. Cryptocurrencies are in full mode, being utilized by other countries. If the dollar collapses, it may trigger the market crash in 2018. Now, knowing all this information, how do you actually profit? How do you profit from knowing all this? How do you make sure you avoid what many people went through in the year of 2000 in the tech bubble in the year of 2008, if we were just to look at the recent two crashes. Well, there are definite strategies that you can implement starting today, like buying long-term put options, which will expire in the next couple of years. They're not risky. They will give you a great opportunity to profit from the market crash. And if you visit marketcrash.money, there is a link here that you can click, and it goes over a couple of good examples how long-term options work. Now, for some of you that like to find a way how you can make a lot of money in a short amount of time, I do have a solution. Just click this link here, how to profit. Schedule a one-on-one consultation with me where I'd be able to provide you with a specific strategy and a plan of action of how you can capitalize on a potential market crash and therefore protect your assets, protect your family, and possibly create wealth, not just for yourself, but for the coming generations in what may end up as one of the greatest crashes in the United States history. Thanks for watching. I hope this was helpful. Feel free to reach out to me at the number provided in the description. Thanks.